We are talking about money here, and here are some here to discuss some ways that you can invest with target date funds is Brent Wilsey, President and CEO of Wilsey Asset Management. Brent, good morning. Nice to see you.
Good to be here.
So the first thing I want to talk about is that your firm has a partnership with the San Diego Padres, and you got a pretty big day coming up for you out there on Petco, huh?
Yes, I do. Next Sunday for the Padre-Dodger game, I'll be throwing out the first pitch, and I have a lot of respect for these pitchers now. Throwing a ball 66 feet in that small box is not that easy, I found out.
Are you practicing?
I have been practicing, yes.
It's got to be a little nerve-wracking, I would imagine.
It is nerve-wracking, and again, been practicing on it, so I'm very honored. I figured only 80 people a year get to do this, and over 10 years, that's only 800 people. It's a big honor. I'm very thrilled that they asked me to do this.
At least you're not singing the national anthem. That would be a little more nerve-wracking.
I would empty the stadium if I did
that. Before we get into, we're going to talk about target date funds, and I know a lot of people are interested. But before we get into that, can you talk a little bit about the partnership with the Padres? I'm just very fascinated by that.
Yeah, it's a partnership we came up with, and we're throughout the stadium. We're on the TV screens. We're on the scoreboard. I have our stuff put with the Padre players, so we're there to answer them questions. So it's called an investing partnership with the Padres, and we're honored to do that. It's just great to be part of the Padres and be there. It's been very exciting for us at our firm to be with them, and great guys down there. Thor and the guys that we work with, they're just fantastic guys working down there at the Padres.
So target date funds, what are those?
Yeah, target date funds are something that have become very popular because there's about $3 trillion in target date funds. And what happens is that there's something that they're easy for people to work with. And a lot of times they're using a 401k fund because you're looking at retirement. And to give an example, so you're 45 years old, you're saying I'm going to retire at 65 years old. Let me pick a target date fund that will mature at 2050. And I say mature, I use that loosely because they really don't mature. But what it does is it tries to make investing simple for people. So as you're younger, say you're 30 years old, about 90% of the investment will be in stocks and 10% in bonds. As you get older, you get to 55, 60, 65, it may switch to maybe 20% is in stocks and 80% is in bonds because you're close to retirement, you should be more conservative.
So how do they work?
Well, how they work is actually that they will invest in stocks and bonds. They can use foreign investments. There's many different ones as well that you actually have out there. So you got to be careful. And they will, as you get older, they will progress and change their mixture for you. The problem with them is that they don't realize how old you really are. And because, right now, I have many clients in their 80s. So if you say at age 65, you should be in a 90% bonds, 10% stocks. In 2022, that was disastrous. You lost about 20% of your money. So that's one problem with them is that they don't really go to your lifestyle more towards a date. I don't really like them for that reason. And also they don't match to what else you have in your portfolio. You may just have them all your 401k where their portfolio could be different. So that's one of the many things I don't like about the target date funds.
What are the benefits of it? What do you like about it?
Yeah, the benefits are is that actually they're very simple. You put them in there, you forget about them, you do it. Also, too, what I like about them, there's no market timing. Many people, we have this saying that a portfolio is like a bar of soap. The more you touch it, the smaller it gets.
Interesting.
So with a target date fund, you put it in there and you forget about it. Don't look at it. We tell our clients all the time in our portfolios, look at them twice a year. January 1, December 31st, because the more you look at it, the more you touch it, the more you're going to destroy what it's doing. So that's the benefit of the target date funds, is that they're simple, there's no market timing to them. I do worry that people will change them when things go down. Oh, I'm going to get out and so forth and try to time them. That's a problem.
So if somebody's working with a financial advisor, do you recommend they contact that advisor and say, hey, I'm interested in target date funds? How do you recommend for some of us, maybe who aren't using these right now, kind of going forward?
My feeling is if you're going to have an advisor, you probably don't need the target date funds.
I see.
Or vice versa. If you have target date funds, you don't need an advisor because they're supposed to be just do them, set them, and go. I don't, again, prefer them. I'd rather have them managed and look at your situation, your other assets, how long you're going to live, all these many factors. But if you're in your 401k and you set a target date fund, you put it in there, you just forget about it until 2050. That's what you're supposed to do. I don't know if that's going to happen or not, but that's what's supposed to happen with them.
And let's talk a little bit about the S&P. It's been up, yeah?
Yeah, S&P is up about 8% year to date, and there's something that's not going on that hasn't happened in 25 years. And what that is that right now it's very concentrated. About $1.4 trillion increase in market cap from just 6 companies
Wow.
that has caused that 8% increase. Now, why is that? Because they mentioned about AI, artificial intelligence, and the reports. And there's other companies doing extremely well, but because these 6 companies, oh, we're in AI, they're up dramatically. So the S&P 500 is 500 companies, 6 companies very responsible for that 8%. I don't think it's going to last, so be prepared.
Do you think that's a good thing, that 6 companies are?
No, it's a bad thing.
Yeah.
It's a bad thing, yeah, because it's heavily concentrated. And those
Right.
companies I know, they're like Microsoft, they're NVIDIA. They're very pricey. And we've talked many times about growth companies like that, how they're very volatile. They can go up dramatically
Right.
and then fall dramatically. And you're like, oh, what happened there? So
Right.
I don't like the S&P 500 being so concentrated on those 6 companies, and especially because they mention AI.
Right.
Because when you do stuff like that, it's a hot thing now, and there's nothing to follow up with it.
I'm reminded of the dot-com boom in
There
the
you
late
go.
90s.
Yeah.
I saw my portfolio go up 3,000% and back down to nothing, just
Back
like
down.
that. Well, Brent Wilsey, I always appreciate you, sir. Thank you for coming on.
Well, thanks for having me.
All right, well.